What is a fair value gap in the ICT method, and how does it help explain price inefficiencies? A fair value gap is a three-candle pattern that reveals an imbalance in price delivery, creating a gap between the shadows of the first and third candles. Let us first look at the bullish fair value gap, often referred to as BISI. BISI stands for buy-side imbalance and sell-side inefficiency. A bullish fair value gap forms when the upper shadow of the first candle does not overlap with the lower shadow of the third candle, leaving a clear gap between the two. To make this clearer, let us compare two price movements, one where a fair value gap is present and one where it is not. On the left, there is no overlap between the upper shadow of the first candle and the lower shadow of the third candle, which creates a fair value gap. On the right, the upper shadow of the first candle overlaps with the lower shadow of the third candle. The bearish fair value gap is commonly called SIBI, which stands for sell-side imbalance and buy-side inefficiency. A bearish fair value gap forms when the lower shadow of the first candle does not overlap with the upper shadow of the third candle, again creating a gap between the two. Let us make the same comparison for bearish structures. On the left, there is no overlap between the lower shadow of the first candle and the upper shadow of the third candle, resulting in a bearish fair value gap. On the right, the lower shadow of the first candle overlaps with the upper shadow of the third candle, which means there is no fair value gap present. Another important concept related to fair value gaps is known as consequent encroachment. This simply refers to the midpoint of the fair value gap, or the 50% level of the gap. Fair value gaps can act as areas of support and resistance, similar to other structural levels. Because of this, it is important to observe how price reacts to the boundaries of the fair value gap and to the consequent encroachment level. Let us start with bullish fair value gaps. In an ideal scenario, price reacts at the upper boundary of the fair value gap by trading into it and then closing above it. This behavior suggests that price is respecting the fair value gap. Another valid reaction occurs at the consequent encroachment. In this case, price pierces the midpoint of the fair value gap and closes above it. It is common to see price retest the consequent encroachment shortly after. In the next illustration, you can see the bearish version of a fair value gap reaction. The principle remains the same, but the structure is inverted. Just like other forms of support and resistance, price can also move through a fair value gap and later react from the opposite side. In ICT terminology, this behavior is called a fair value gap inversion. On the left, you can see a hypothetical example of a bullish fair value gap inverting and leading to bearish price movement. On the right, a bearish fair value gap inversion leads to bullish price movement. This behavior closely resembles the classic switch and test seen with many support and resistance levels. Beyond fair value gaps, the ICT method also highlights related concepts such as volume imbalances and gaps. A volume imbalance occurs when there is a difference between the open and close of adjacent candles, even though trading activity exists within that area because the candle shadows overlap. A gap, on the other hand, occurs when there is a complete absence of trading activity between candles. In a bullish gap, there is space between the high of the first candle and the low of the second candle. In a bearish gap, there is space between the low of the first candle and the high of the second candle. In the illustration, you can see the bullish versions of a fair value gap, a volume imbalance, and a gap placed side by side for comparison. In the following illustration, the bearish versions of all three patterns are shown. Keep in mind that fair value gaps, volume imbalances, and gaps can often be used in a similar way when analyzing price behavior and potential reaction areas. Let us now move from theory into practice and observe some real examples of fair value gaps, volume imbalances, and gaps, starting with a very simple case. We begin with this 1-hour chart of the dollar index. By moving one candle into the future, we can identify the formation of a fair value gap, since the upper shadow of this candle does not overlap with the lower shadow of the previous candle. It is common for price to return to a fair value gap before continuing in its primary direction, although this is not the only way fair value gaps can be used. As price continues to develop, moving one more candle forward reveals an important reaction. Price trades into the fair value gap and then immediately reverses to the upside, continuing its main movement. Notice that if the lower shadow of the next candle does not overlap with the upper shadow of this candle, a new fair value gap is created. In the following candle, this is exactly what happens, resulting in the formation of another fair value gap. Looking closely at the next candle sequence, we can observe an inside bar formation that does not enter the most recent fair value gap. In the candle that follows, price trades into the fair value gap and closes above it, clearly reacting to that zone in a similar way to the previous fair value gap. After this reaction, price resumes its upward movement for several more candles. If we shift our focus slightly forward in time, one additional candle reveals the formation of a gap. As shown on the chart, this gap can be marked in the same way as the fair value gaps. The principle remains the same. This is an area that price can later return to from the opposite direction, and in some cases, we can also observe inversions. In the very next candle, price reacts to the gap in a similar manner to how it reacted to the earlier fair value gaps, and then continues moving higher. It is also worth noting that the current candle is reacting to a fair value gap that formed immediately after the upward gap. Staying with the dollar index, but now shifting to the 4-hour chart, we can see a clear example of a volume imbalance. There is a gap between the close of the previous candle and the open of the current candle, yet there is trading activity within that area, which characterizes a volume imbalance. Over the next few candles, we can see how this volume imbalance holds price, and eventually the market begins to rise from that level. So trader, please remember that the ComLucro channel is focused on giving traders clarity, confidence, and structure. And this Smart Money Concept series is designed to do exactly that. Each video breaks down one ICT concept in a clear and practical way, helping you understand how price behaves, where liquidity forms, and how market structure develops. If this explanation helped you see the market with more clarity, make sure to check the full Smart Money Concepts playlist linked on the card and in the description, where all these ideas are organized step by step into a complete learning path.